This is the monetary policy statement for October 2016. Inflation has continued to slow down. Annual headline and core inflation declined to 4.1% and 4.2% in September 2016 from the respective 4.8% and 5% in August 2016. The main factors behind the inflation slowdown include weak consumer demand, decreasing inflation expectations, and relatively stable exchange rate dynamics on the back of moderately tight monetary policy 12 months prior to this. However, because of the drought in many parts of the country, food crop prices are rising, with annual food crop inflation increasing from minus 1.9% to 5.1% in the last 3 months. The revised gross domestic product data, I think was released this month, indicates that the economy grew by 4.8% in financial year 2015/16, up from an earlier estimate of 4.6%. High-frequency indicators of the Bank of Uganda also point to a significant pickup in economic activity during the fourth quarter of fiscal year 2015-2016, which has continued in the first quarter of 2016-2017 fiscal year. The economy is projected to grow in fiscal year 2016-2017 at about the same rate as in the last financial year. Domestic demand will be a key driver of growth in the current fiscal year. The overall economic outlook remains largely unchanged from that in August 2016 monetary policy report. Economic growth is projected at 5% in fiscal year 16-17 and between 5% and 5.5% in fiscal year 2017-2018. A gradual recovery in private sector credit will support private sector spending and economic growth. Nevertheless, there are risks to the balance of payments arising from weaknesses in the economies of some of Uganda's trading partners and the potential volatility in capital flows. Inflation in 2016-2017 is forecast to remain unchanged from the August 2016 forecasts. Increased demand pressures from the economic recovery are offset, are offset by a decline in costs because of lower imported inflation resulting from weaker global demand. Nevertheless, the forecast for headline inflation is slightly higher, in line with an upward revision of the food crop harvest forecast. While the Bank of Uganda expects core inflation to remain around 5% within this financial year, this will primarily depend on the exchange rate movements as well as on the impact of less than normal rains for the current season. Given that the core inflation is forecast to remain around the medium-term target of 5% over the next 12 months, there is room to support the domestic economic growth momentum, especially against the ongoing global economic slowdown. Therefore, the Bank of Uganda believes that there is scope to ease monetary policy. Accordingly, the Bank of Uganda will reduce the CBR by 1 percentage point to 13%. The band on the CBR will be maintained at plus or minus 3 percentage points, and the margin on the rediscount rate will be maintained at 4 percentage points on the CBR. Consequently, the rediscount rate and the bank rate have been reduced 17% and 18% respectively. Signed by me.